If you know anything about millionaires, you'll know that they are avid investors, and in order to continue to build their wealth, they must avoid investing in the wrong things. Therefore, in this video, I will share with you the 7 things millionaires don't invest in, so that you too can make great investing decisions and become rich yourself. In life, one of the best ways to succeed is to take after the lead of those who have succeeded before you. And this method certainly works for investing. It is why thousands of people spend countless hours studying the investment strategies of people like Warren Buffett and Charlie Munger. Funny enough, these investing moguls also took their investing strategies from those who came before them. For instance, Warren Buffett's investing strategy was learned through his teacher and the author of the book The Intelligent Investor, Benjamin Graham. Benjamin Graham was known for being diligent, almost surgical, in his financial evaluation of companies. His experience led to simple, effective logic upon which Graham built a successful method for investing. This all to say that investing is an intricate art, and knowing what investments to avoid is just as important as knowing which you should invest in. While some commonly thought of investments can seem like winners when trying to grow your wealth, the reality is that some can actually cost you money in the long term, making them things you most definitely should avoid. So which investments in particular do millionaires avoid? Investment number 1, bonds. While it's true that a lot of millionaires do hold some bonds in their portfolios, this type of investment tends to be avoided when millionaires try and maximize their wealth. The first issue with bonds is that their returns are generally much lower than what you could realize by investing in stocks instead. In fact, many bonds barely keep up with inflation, earning on average just 3% annually. For example, in the past 3 years in the United States, the average inflation rate has been just over 2% annually, which means that on a $50,000 investment, you would be ahead 1% or $500 as a net return. So if bonds have such low yields, why would anyone invest in them in the first place? The truth is that bonds are generally lower risk investments than stocks and are rather liquid, meaning that if you want to dispose of them, then you can get your money fairly quickly. Moreover, bonds tend to pay interest, making them income-generating assets. Unfortunately, their low yields make them more of a wealth preservation tool than a wealth generation tool, which is why millionaires tend to avoid putting large sums of money into this type of investment. Investment number 2, penny stocks. Any stock that trades on the stock exchange for less than $5 per share is considered a penny stock, and millionaires avoid them like the plague. Millionaires avoid this type of investment for a few important reasons. First, companies who trade low-value shares are not required to register with the Security and Exchange Commission, commonly referred to as the SEC, and do not have to present them their annual reports. In essence, this means that there is no oversight into the validity of the financial information these companies are reporting, making them very volatile investments. Moreover, having a lack of access to credible financial information makes it very challenging for investors to get a sense of the true value of their holdings, which is an important factor in millionaire investing decisions. Now, sure, these types of stocks do have the potential for exponential gains and significant returns for investors who want to gamble on these unproven companies, but millionaires know that penny stocks are bound to flop. Another reason penny stocks make for bad investments is due to their low levels of liquidity. Because most people don't invest in these types of shares, finding a buyer for a stock you own can be challenging. While most popular stocks are traded thousands of times a day, penny stocks are bought and sold less often, which also affects their price, which is another downside of penny stocks. Holding investments that are volatile in price makes it hard to gauge the true value of your holdings, and can make investing very stressful as you see your money rise and dip to extreme levels over time. So for these reasons, millionaires do not invest in penny stocks. Investment number 3, digital currencies. For the last few years, all anyone has talked about was Bitcoin and other popular cryptocurrencies, but this type of investment tends to be avoided by millionaires. Now, I would be lying if I said that there weren't people who made millions investing in cryptocurrencies, but these people are far and few between. The first problem with digital currencies is that they aren't government regulated. This means that there is no oversight into how the companies behind them are operating, which can be scary if you are investing large sums of money into them. The second problem with cryptocurrencies is that they have no inherent value. Their price is totally speculative, kind of like penny stocks, which makes their price spike when there is hype around them and prices drop when attention cools off. For instance, when Bitcoin received a ridiculous amount of attention in December 2017, the price of a single Bitcoin rose to over $17,000 USD. Then, as attention moved away from Bitcoin, the price began to decline and investors saw their once beloved cryptocurrency trading at just over $3,000 USD 1 year after its peak. Finally, unlike normal investments, digital currencies are at risk of hackers and theft. Take the example of Bitfinex, a Bitcoin exchange company. In 2016, the platform was hacked, resulting in depositors losing over $70 million. Sadly, this instance is not uncommon. As highlighted in the US Department of Homeland Security study, roughly 1/3 of all Bitcoin exchanges have been hacked at one point or another. So if you add up all these elements and the fact that cryptocurrencies don't produce income like investment properties or dividend shares do, there's no wonder why millionaires seldom use digital currencies as a primary investment vehicle. Investment number 4, certificates of deposit. Another unpopular investment of the rich are certificates of deposit. If you're unfamiliar with certificates of deposit, or CDs for short, then let me explain what they are. A certificate of deposit is a product offered by banks and credit unions that offers an interest rate premium in exchange for the customer agreeing to leave a lump sum deposit untouched for a predetermined period of time. Essentially, you're trading access to your money for interest income. Unfortunately, CDs have the same main disadvantage as bonds. They don't offer very substantial returns, meaning that again, you will struggle to fight inflation by investing in them. In fact, as of September 2019, the highest CDs only yielded 2.25% annually. One upside to certificates of deposit is that they tend to have shorter terms than bonds, meaning that you can get a similar return while being without access to these funds for a shorter period of time, which equates to less risk. While CDs aren't a terrible investment, millionaires expect higher returns and rely on these returns to build their wealth faster, which is why certificates of deposit aren't the investment of choice of the rich. Investment number 5, collectibles. The next type of investment millionaires avoid are collectibles. Collectibles include things like art, antiques, stamps, classic cars, wine, and comic books, and believe it or not, they are big business. According to a report by Deloitte, the market for collectibles was $362 billion in 2012, and it was expected to grow year over year. But even with this expected growth, millionaires still shy away from putting their money into collectibles for a few reasons. First, collectibles are only worth what someone else is willing to pay for them, meaning that there is no real defined price for these assets. Kind of like cryptocurrencies, the asset's value is based on how much other people perceive it to be worth, rather than having a real monetary value associated with it. This means that nice painting you own may be worth a lot to you, but it is worth nothing unless you have a buyer willing to part with their money for it. And to add to this issue, unlike stocks and bonds, there is usually little public information available for individual collectibles, making the valuation process that much harder. The second reason the rich don't use collectibles as investments is because they don't generate income. Sure, a painting is nice to look at, but it won't fill your pockets on a monthly basis, making it a less than ideal investment to hold. Probably the biggest downfall of collectibles as an investment is how illiquid they are. For instance, it takes the right kind of buyer to want to spend thousands of dollars on an antique car or comic book collection, meaning that if you want to part with your collectibles in order to recoup some cash, you may be waiting a while until those funds are received. In short, while growing a collection of valuable items can be fun, they definitely don't make the best investments. Investment number 6, precious metals. The sixth thing that a lot of wealthy people do not invest in are precious metals, and more specifically, gold. Now, I get why some people would want to invest in precious metals. Generally speaking, gold and other precious metals can act as a kind of safeguard against economic downturns. This is because precious metals tend to have an inverse relationship with the stock market. Simply put, when the price of stocks and bonds go down, gold and other precious metals tend to go up, and when stocks are on the rise, precious metals decline in value. You may be thinking, well, isn't it smart to have investments that will offset any losses I may experience? Well, in theory, this makes total sense. The reality is that precious metal prices don't typically go up enough to make up for the losses that you would experience in an economic downturn, making them quite lackluster as a hedging tool. The other issue with holding precious metals is that, like most of the other investments we've discussed in this video, they're rather liquid. Again, if you are in a financial bind and need money, selling off these assets may be harder than you would expect, leaving you without the cash you need. And if you need more of a push to avoid this type of investment, you should know that investing king Warren Buffett thinks that gold is a terrible investment. Buffett believes that stocks are a much better investment and often highlights just how much better returns on stocks have been in the past versus its precious metal counterpart. For instance, if you invested $10,000 in both gold and stocks in 1942, the value of your gold would be now worth $400,000. Now, this seems like a great return, but the same $10,000 invested in stocks would be worth a cool $51 million today, proving just how powerful stock investing can be. Therefore, for these reasons, wealthy people tend not to invest in precious metals. Investment number 7, companies you don't understand. At this point, you've probably come to the conclusion that stocks are the type of investment that millionaires gravitate to, but not all stocks make for a good investment. This is because there are many companies that trade on the stock market that are so complex that the majority of investors can't even comprehend what business the company is in. In fact, experienced investors like Warren Buffett won't invest in most stocks because of how complex they can be, and he's been investing for longer than most people have been alive. Buffett preaches the importance of investing only in companies you understand, and he practices this himself by restricting his investments to those that fall into his circle of competence. His circle of competence is where his investing expertise lies, and only businesses that fall into this circle are considered for investment. Buffett makes the argument that if you don't understand the business, how can you project performance? For example, Buffett did not suffer greatly when the tech bubble burst back in the early 2000s because he was not heavily invested in dot-com stocks. In short, investing in stocks is a powerful tool for growing your wealth, but your investments should be limited to the companies that you understand. In conclusion, if you want to start investing like a millionaire, then you must avoid putting your money into bonds, penny stocks, digital currencies, certificates of deposit, collectibles, precious metals, and finally, companies you don't understand. Thanks for watching. If you want to go from the life you have to the life you deserve, then hit the subscribe button now.